All right, let's kick this off. Thank you, everyone who joined our webinar today. My name is Stephen Epstein. I'm the CMO here over at True. True is an AI organization focused on leveraging both artificial intelligence and machine learning to automate the intelligent processing of lending data. We call this lending intelligence. On today's webinar, we will be discussing how the lending industry can leverage AI to drive trust in borrower data, resulting in previously unimaginable improvements in operational efficiency, productivity, and quality control. I'll be moderating the webinar today, and I'll be joined by four distinguished gentlemen from our industry. Kevin Perano, who is the Chief Lending Officer from PRMG. Garth Graham, Senior Partner at the Strathmore Group. Tom Gallucci, Senior Vice President, Business Development at the Mortgage Collaborative. And Devin Daly, our CRO here at True.
Thank you for the intro. Can you hear me, KP?
Yes, KP, welcome.
Thank you. Appreciate it.
We're on and we're live. Thank you for joining us today. Before we start the session, I just wanted to cover a couple of housekeeping items for everyone. You're listening in using your computer speaker system by default. That's how On24 operates. If you prefer to join over the phone, just select telephone in the audio pane and dial information will be displayed for you. You will have the opportunity to submit text questions to today's presenters by typing your questions directly into the questions pane of the control panel on the right. You may send your questions anytime during the presentation, and we'll cover them as we go through our dialogue and the material. Lastly, the webinar is going to be recorded, and we plan to share a webinar recording with everyone who's registered and attended the session. So if you miss any of this, don't worry, you'll pick up the recording by email in a day or so. So let's kick things off and get the discussion going. I think we have a bunch of really great topics to cover here, and I also like to thank everyone who registered and some of the questions that you folks sent in. I think we're going to cover those at the same time. They're awesome questions, but today's topics are really centered around four core areas. The first one is why is borrower data such a challenge for lenders? We all live in the lending industry and we understand data is coming in all the time. Our borrowers are sending in all different types of documents. Sometimes these documents have really great quality, sometimes they don't. But either way, it's hard very often to understand what's right and what's wrong, what's quality, what's not quality. And we're going to talk about the challenges the industry faces, and we're going to talk about how AI plays a role in helping to overcome some of those challenges. The second topic, we'll talk about how AI can be integrated into origination and secondary market processes. I think we're all very used to processes that have been around for decades that have been automated to some degree, but are often very labor intensive and require human intervention. These processes, are evolving over time, and AI is playing a role in that. So we're going to talk about that role and how everyone can benefit from the introduction of AI into these processes. We'll also talk about the impact on the lending business model. At True, our customers, as they start to adopt our AI and start to automate a lot of their processes, they see how their own business models are changing based on really amazing improvements in operational efficiency and productivity and much better quality control. So we'll kind of unpack that and really understand the true impact of that. And we'll also talk about the winners and the losers in an era of AI-led transformation. I'll share a little story before we get into the dialogue here, but I was on a call recently, and a CTO was being asked by many of her constituents, will I lose my job because of AI? And her response, I thought, was really clever. And she said, well, you're not going to lose your job from AI. What you may lose your job from is people who are using AI to be more productive and more intelligent in their job and their daily tasks. And her point was really clear. Like, there's a lot of opportunity to be more productive and to learn from these AI technologies. And as knowledge workers, we can just add a lot more to the business and be a lot more productive in our own job and be a lot happier in our own job when we leverage a lot of these new technologies. So I thought that was a clever response. Regardless, we're going to go around the panel and we're going to see what the other panelists seem to think about that. So with all that said, let's kick things off. I'm going to start actually, Garth, with a question to you. And the question here is, why is borrowed data such a challenge for lenders?
Sure. Appreciate the opportunity to be here. I think one of the biggest problems is in our industry, the mortgage banking industry per se, is the borrower does not have all the data that you actually need to complete the loan. And whatever data they have isn't trusted. So there was a lot of discussion in your white paper that you released, which I thought was interesting about the impact of trust or lack thereof. So, we talk to a borrower and we say, give me your social, we get your credit report, we got data. It's good, and usually it doesn't change. Everything else we don't believe. So can I have your income? I don't believe you. Give me a pay stub. How long have you worked there? I don't believe you. Give me a W-2. How much money do you have for down payment? I don't believe that either. I'd like the bank statement, and I'd like all 7 pages, by the way. Don't just send me 6, because that 7th page may have something that fundamentally means I'm going to reject your loan because you are not worthy. Now, this is a very snarky comment, but really that's really what's kind of broke in our whole industry, is that nobody trusts the data that is being provided to them, even throughout the process. So then it's, the loan officer might get the pay stub, but the underwriter doesn't trust that they read it right. And the processor don't trust that the underwriter asked for it, so they've asked for it again. So we just go through the same process, and then we layer systems on to try to make it work better. It's trying to overcome the fact that there really is not a trust of the data that is being provided at any step in the process.
That's great, Garth. So, I wonder where this distrust comes from. I mean, I think we all know the answer, but maybe we can spend a few minutes on it. Obviously, the goal here is to trust the data. And, technology can take a look at this information and kind of give us levels of confidence and understand whether, documents have been manipulated or could cross-validate information across other document sets to figure out, is there a high level or low level of confidence, whether the data itself is reasonable. But, since distrust kind of lives in the process, I'd love to kind of know from the rest of the panelists, where do you think we can start to up-level this and start to gain some trust in the data outside of what some of the technology can provide out of the box?
Well, we can start with page 7, which everyone knows in the bank statement is left intentionally blank, and there are even memes about it. But yes, you do have to provide that blank page. So Garth, you're right. We have a data collection problem, and I will say one positive thing is that millennials dominate first-time home buyer percentage, and they willingly give us everything: usernames, passwords, access to all their stuff. They don't want to talk to us. They just want us to get it done. They actually are trying to help us be data driven. So I think one thing that we could do, and I'll let Devin bring up the 5-year-old joke that he and I have running about document collection, but I think day one certainty is highly underused. And it's funny, I was prepping for a panel with CoreLogic that I'm doing in July with them, and one of the things you brought up is how originators still don't use day one certainty, and part of it is the assets. It's like I tell FHFA, I tell Fannie and Freddie, I tell them all the time, but originators are not using these tools that are just pure data driven because they don't want to get assets that show a large deposit that blow up a deal. So here we are, 8 years after Rocket Mortgage introduced push button get mortgage, which they were the first ones to get access to day one certainty, and we still don't have 100% compliance of day one certainty on all of our loans. Imagine if you had a large deposit, and now you got to source it, you got to see if it's a liability, does it show up in the credit report? I don't really know. So originators want to see that. They still want to do the back and forth on bank statements, and they don't want to just have the button pressed because the guidelines from Fannie and Freddie, FHFA, say that large deposits need to be sourced. And I've been pushing on Fannie and Freddie for years. I go, why do you guys care? Because the reality is originators just wait 60 days, and then they only show you the bank statements where there's no large deposits and the average balance is there, and that money's good. And if it doesn't show up on a credit report, then it's not a liability worth mentioning. That's what happens in real life. But that's what keeps our process so long and less data-driven when the tools are there to do it. And that's just one of many examples. It's probably the most egregious example I can think of. So I try and make the case to Fannie and Freddie, why do you guys even care if there's a large deposit? It's for the down payment, which is a one-time payment. If it doesn't show up on the credit report, is it really a liability? So that's just one impediment to being truly data-driven.
That's great. That's a great example. Devin, I think this is a good segue to you, actually. You know, we at True are always trying to look at all this data coming in and evaluating it, and using our AI models to determine what is trustworthy and what's not trustworthy. And I know you live in that world every single day, talking with customers and, you know, working with our product teams and so on and so forth. Maybe you can take the question on a bit more and just talk a little bit about how can technology be used, AI, to help drive, you know, more trustworthy data.
Yeah, absolutely. Thanks, Stephen, and thanks everybody for joining us today. There are a lot of broad areas, and I think importantly for the industry itself, and Garth has mentioned it, and Kevin's mentioned it. We tend to do things either, you know, over decades or very, very slowly with baby steps, and I think, you know, we've got to get acclimated to that because there's a lot that goes on, right? There's people who've been in the industry tend to be here a long time, so we've got to get used to things. You know, income analysis is an example. How do you tell an underwriter to stop calculating the income if they still have access to it and just trust this engine that just did it? So I think first and foremost, it's about lenders experimenting with AI in particular areas. And Stephen, one of the things that you know this is, and part of our approach is, why don't you start with post-closing QC? Because oftentimes what I found is that it's a black box to a lot of lenders, right? They don't have a lot of good data coming out of post-closing QC that they could then leverage in other parts of the business to say, here's where my defects come in. Here are the defects with the most economic impact. And I think by leveraging AI and evaluating all of those, let's call them data failures and document failures, and documents missing, documents amongst themselves from an authoritative source to a non-authoritative source. There are discrepancies. There are discrepancies from the authoritative documented source or the direct source data to data in the loan file, and be able to unearth those and quantify them. That's a prime candidate for AI for me. And then that gives a lot of information to the lenders that they can look at and say, all right, you know, we've got 50 problems, right? That's probably way too few, but we've got 50 problems. Let's quantify the impact of each one of these. And maybe at the bottom, there's really zero impact. It's just, you know, it doesn't impact cash flow. It's just a trailing doc that I've got to get, you know, over to an investor. But at the top of the list, there's buyback risk, there's stipulations, there's, you know, increased dwell time. And how do we then take that information that AI's provided us and shift left and correct those problems upstream? And again, the answer is AI. Let's detect it. But based on this experiment, now let's experiment in other areas, but it's not really an experiment anymore because we know that technology works. We know we can detect discrepancies and correct them when they're entered.
So that's really interesting, Devin. I think intuitively we would all say, start from the left and work to the right. So start at the data ingestion step to get the data as clean as possible and use AI to do that, and then slowly layer in the AI through your entire process to the point it's used all the way on the right in quality control. And you're saying no, actually. You're saying get to know your data better, get to know how the AI is going to interpret your data and clean your data and verify your data. And then when you really understand how that operates, start to move that upstream, I would imagine at some point all the way to the left, where you're then using it to verify every document that comes in, extract every data point, cross-validate information before it actually gets through the lending process. I think that's a really interesting takeaway for all of us to consider.
Yeah, I think,
and it's purposeful, Steve. Sorry, Garth, go ahead.
No, I was just going to say, I think the one trick on that is if you're going to do it that way, you're going to have to measure success not just based on how much more efficient you are in that step of the process, which, by the way, is not a particularly expensive step in the process. So there's not going to be a huge ROI from that, but you may inform people, process, and or technology changes you should be making further upstream. So, I mean, I think that's probably I think the tricky part is when people think too big about the return on investment too fast, and do not accept the change management around people and process. So it's going to require people, process, and technology. Kevin's first thing he said is, hey, trying to get the loan officers to change their behavior is very challenging. Thus, they won't change the process. Thus, they don't use the technology. So, and by the way, that's your biggest cost. So one of the tricks of doing the post-closing, which I think is a very good idea because it isolates it, it's less complex, it's not as much process. The trick, though, is you just got to accept the fact that your initial ROI will not be as high.
Garth, if I could chime in, and Garth, you're spot on too. Like, if you try to take it from an approach of we've got to try to solve these 50 issues to get that ROI gain that we're expecting, you almost fall back into that same trap where you get overwhelmed by the data at your fingertips and don't know what to do with it or maybe what direction to go with it first. I know we had a prior webinar we did in conjunction with True, and Mike Metz at VIP Mortgage talked about, taking a bite-sized approach like Devin was speaking to. And I think that can also help with the internal confidence level behind the technology and the cleaning of the data is once you start to find smaller use cases that can even make a small efficiency gain, multiply that over a multitude of loans, it starts to quantify quickly. And then I would imagine the creative wheels start turning for other components of your loan process. So where you can kind of apply the same logic and start making additional efficiency gains.
Yeah, Tom, that's great. Let's stick with this for a moment. So let's imagine the lender, picks a very specific point in their process they want to apply AI to. Maybe it's in post-close QC, maybe it's further upstream. But eventually, through that learning and success, they apply a lot of these AI models across a good part of the entire lending process. And you start to see some really big transformation in terms of operational improvement and productivity and accuracy. What do you think the impact would be to the lending industry and to lending business models once a lot of these AI technologies are applied across the entire lending life cycle? Do you have a perspective on that?
Yeah, I mean, not to oversimplify, but it's efficiency gains, period. And then to expand upon that, I mean, if you're applying it across your loan processes, you should see the results of quicker turn times through, less human errors, errors or deficiencies that are caught earlier in the loan process, like you were talking about, eventually applying processes upstream. And then in turn, you're going to reduce your loan level and your fraud related risks as well. So, on top of that, you're getting to an eventual state of a better allocation of your human capital, which can lead to a more high-touch, positive consumer experience. And you're allocating your people away from redundant tasks to where they can best be utilized to represent your organization. And in turn with all that, on a macro level, you should, in essence, create the ability to take on more volume and in turn be more profitable, pending we have the volume coming in. But I guess to be a little bit granular, more real quick here, the touchless automation is where we want to get towards, and then that can allow like an exception-based workflow you guys talked about within True's white paper. And I think that's the goal, is creating these scenarios where the only human interaction is on an exception-based workflow, and using the brain power to kind of assess more complicated loan files or challenges in that process. And I would imagine lenders would be very apropos to these types of solutions for just staffing control too. I think the lenders I talk with, particularly IMBs, they're still scarred from these massive hiring and firing cycles our industry's kind of gone through the almost roller coaster ride of volume up and down we've experienced over the last 3 years. And, I'll just close with, I think Rich's commentary in your white paper where he refers to the impact of AI and clean data in a business model is essentially, it's a game changer because it's the opportunity to eliminate such a huge percentage of existing loan manufacturing costs that are largely dedicated towards your labor costs in both your processing, underwriting, and then other components of the operational process.
So I've got one I want to hop in here since we stopped at we said, hey, let's start at the end of the process. Let me make an observation about the top of the funnel. Mm-hmm. Coming out of the 2021, oh yeah, those are the days. We were coming out of a capacity, basically a capacity market, meaning we had too many loans and we're trying to process them more efficiently. We are now in a market of a scarcity. Yeah. There's not enough loans. And really the biggest problem is a staggering number of pre-quals not getting to application because they've not yet found a home. And it's extremely expensive to manage all those prospects with such low pull-through. So what does that have to do with AI? Anything which would, if you could analyze all the data available from the consumer as well as from third parties and somehow say this one is most likely to buy a home sooner, find a home they're looking for, sell their existing. Now, this doesn't really exist, okay? So I'm talking, though, a little bit theoretical, but boy, that could move the needle if you then have the people and process to do something with it. Because there's even not, and I'm not even talking call centers, retail loan officers have never had stacks of these leads and pre-quals that just aren't going anywhere. And they're not used to dealing with it. And if you could just say, here's the one, go after this one or help this one, it could be extremely valuable.
Gavin's spot on. I mean,
I don't know if you teed me up. You teed me up there because what I will say is when I was in the industry, I created the pre-qual score. I used a data science team out of Princeton University. I used, I'll give them a plug. I used a call center called Credify. And I had them do, I'll tell you, we talked about organizational change. What I became tired of was asking the sales organization to change. And I said, all right, we're just going to do it for you. And what I meant by that was I gave the loan officers, key loan officers, this pre-qual score of 1 to 10 and said, there's an 86% probability that a 1 through 3 is going to close with you. So 4, 5, and 6, give 10% of your time. The rest, give none. Was there a behavior change? There was zero behavior change. But what we did was we put those pre-qual scores of 1, 2, and 3 into the call center for follow-up and nurturing, and it worked supremely well. So you're spot on with that. And that was the result of predictive modeling.
Right. And the only thing I'd add is you see it in the stats that MBA puts out on a quarterly basis when you see the amount of cost to produce a loan just staggeringly heading upwards. It's all that expense being put towards pre-quals and other applications that never make it to the closing table that then have to be filtered into your cost to produce those loans that do close.
Yeah, that 100%. So I think real quick, at Strathmore, we aggregate data for the industry. A lot of it is that cost data you just referred to. So at least, make sure people realize, and which is why I am focused on that pre-qual piece or brought that up, 50% of the cost is in sales. And I started as a salesperson first, so I'm not, poking fun at anyone other than myself. But 50% of it is around that sales expense. Underwriting is, about $500 sales is 5,000, processing is 750, closing's 250. Yet we spend an awful lot of time focused on tools trying to wring out money out of the $1,500 in fulfillment. And we don't spend enough time, I think, and attention on trying to wring more productivity or lower the expense in sales. And it is, it is the industry's biggest problem in it, but it's just very, very hard to tackle because, salespeople are worth a lot of money. Isn't that right, Kevin?
Hey, I'll tell you, I mean, that's where, since July last year when the industry just took a crap on itself, and that's where a lot of our dollars went to was things to make sales, activities, reduce friction, compress time and scale our business. And, some of it is, trying to find leads or trying to have a better point of sale using soft pull credit. I mean, we've been on the soft pull credit train for 17 months. I mean, it's almost 2 years. Mm-hmm. We've been running it through a point of sale and, running that through DULP, and getting findings before going a hard pull. And that's and then the credit, then FICO raised their price and the bureaus raised their price even more. And then the credit agencies, and they raised their price, right? So that all just became expensive and more of a cost. The commission part of an originator, it's a touchy subject because you've got, different models out there. And, you're kind of seeing with operating expense, like you said, that $1,500 in ops, right? That's a good number. That's a good goal, right? If you're at 1,500, you're probably an apex lender when it comes to OpEx, right? And so you are the great white shark. You dominate. Your average independent mortgage banker is probably somewhere between $2,700 and $3,500 operationally cost to produce a loan, and that's because we're built to scale. A lot of us, have all these departments and this and that and headcount. Although I think most companies have right-sized operationally in the last 12 months, but we're built to scale. I mean, we're built for 2021 and 2020. And so you have to deleverage that down, and there's less units, which make it look even worse. So, like you said, Garth, there's only so much you can do on the ops side. You get it to, if you're 2,000 or under, you're really doing well. Now, then you put that focus back on the originator. I mean, they're the ones out there doing the hand-to-hand combat now more than ever. And honestly, there's too many originators in the business. And so, but they're able to survive. Loan amounts are larger than ever. An originator can make 75 basis points on a couple loans a month or even 3. And they're making a living during the worst time of our industry in a while. So it's hard to fight that battle for the originator if your model is one that's originator-centric. Literally, my company we're built by originators for originators, so we cater to them. We have to pay them. They're the ones that bring us the business. We built our whole model around them. But the flip side is consumer direct, where you don't pay, anybody anything, and you're just all, refi driven, basically. They're hurting too right now. And banks are supposed to be dominating this part of the cycle, and they were, because they don't pay their originators very much. And the bank draws a crowd and brings in business on the origination side. And, unfortunately, though, since March, they've all cut back too. There's a liquidity drain going on. And so they're not exactly out there. It's hard to find a jumbo loan on these bank balance sheets. So it all comes back to deflationary technology. How are you using data and AI to help all facets of your business, reduce friction, compress time, and then scale the business?
Yeah, good.
So Kevin, this is a great segue then to you. And I think you can kind of close the conversation here with the last question, and that is, who will be the winners and losers in an AI era? I mean, we've talked a lot about the entire process and where we can get the most amount of ROI and so on and so forth, where you start, where you end. But at the end of the day, there's going to be winners and losers. And how would you kind of categorize how this is all going to shake out over time?
Well, our business is a capacity model.
Yeah.
And so it's large. I mean, we can control, but there's a lot of macro factors that we don't. Like, if you want a real dose of reality of like how much, like, let's take Wall Street, for example. Like when they're looking at publicly traded mortgage entities, they don't care who's number one. They don't care market share. They don't care how much of it's publicly floated versus not. Rates go up, business goes down. Rates go down, business goes up. That's it. That's how they look at it. And there's some simple truth to that. And so in the down cycle, what you do with your resources and time and investment dollars matters for when the upcycle comes back. And so, for us, I mean, look, AI is a buzzword now, a lot more than ever because of ChatGPT, but AI has been around forever. I mean, to be fair, there's no I in AI. Like the computers don't think for themselves. They learn, they have algorithms, they kind of learn within guardrails that are placed on it by the programming, the machine learning, the rules, the data it ingests, the way it calculates it. But there's not a robot taking over Skynet and going to shoot us all tomorrow, right? So it doesn't think for itself. But the AI has been there. I mean, you guys have robotic process automation. You guys help us with our, let's say we're using guided UiPath software. You help us tinker with certain parts of the process to be more cost effective and put together something. ChatGPT, for example, which is a large language model ingestion type of AI, that's great for upfront. I got a friend, Joe Wilson, owns Social Coach. He's out there promoting how to get through writer's block and create content for sales to put on social media using ChatGPT. And so, AI is coming, and I think you said it well earlier when will AI replace my job? Well, your job will be replaced by people who incorporate AI and use it better, and run a better business. And at the end of the day, no matter where you are in that stack, next year is going to be the fourth biggest year ever, because you're going to have 2 years of first-time home buyers at 6 to 7% rates with larger loan amounts, by the way. And they're all going to be eligible for refi as soon as the Fed starts to cut the rates sometime in 2024. And even if it's the fourth biggest year ever, it's going to feel bigger because there's less people and competitors in the industry. So what you do between then and that Fed rate cut, investing in AI, investing in your tech, will have huge returns in a year like next year.
That's great, Kevin. I'd like to go around the panelists and see if you guys have similar comments or other ideas around the winners and the losers potentially.
Yeah, I mean, I'll jump in just to piggyback on Kevin's comments. And I think he's a great example with PRMG. It's looking to adopt AI or other emerging technology tools as soon as possible into your loan process, and leveraging a time like this where originations are down to be able to gain a comfort level throughout your organization and assess different components of your existing process. We apply these technologies and then experience those gains and essentially create a better consumer experience. So to Kevin's point, as the origination cycle turns and we have all this new refi eligible loan volume, got better processes in place to produce those loans in a quicker fashion, and not as strong of a need to hire up as much and get stuck in that battle that many lenders were in 2020 and 2021, where you're paying top retail, for quality talent to come in and help support your gaps and labor shortage.
I think I kind of already covered the one that I would say. The winners are going to be those that invest in the people, process, and technology to leverage this opportunity. I think the biggest problem is some lenders think it's just the technology and don't focus on the people and process part of it. So I think that the winners are probably not going to be the ones that pick any different technology. We see it all the time. We see 80% adoption and 20% adoption, same tech. That's just people and process. The one thing I will make, and I've used this as a joke in the past, so I'll go ahead and just, deliver it to an audience of 3 because they're the only ones that can chuckle. So I'd say the biggest technological advancement we've had in our industry is desktop underwriter in the mid-90s. Fundamentally changed things, but it took a while. And it really took until the agency said you have to do it before the adoption took off. The second biggest adoption, technological advance we've had since then, the biggest one, the dual monitor. So that's the applause one. So while that is a joke and is silly, but think about the winners are going to be the ones that don't need the dual monitor. Because the idea that a human has to stare at a document because I don't trust the data in the system and then enter the data from the document into a system and then store the document so someone later can look at it because you don't trust me is just kind of nuts. But that's what we do. We still have dual monitor. I, by the way, have 3. So, I'm like all in this. But that's just, maybe the winner will be the company that no longer needs to have a dual monitor in order to manage their data.
So stare and compare has to be retired.
It's got to
be. It just has to be. If AI can't do it, nothing will. This has been a great conversation. We have a couple of questions that came in. I think one is especially really interesting for this panel. It's a long question. It talks about current processes today and processes, tomorrow with AI, and a question around, well, if you look at post-close QC and we look at how we do it today, and maybe Devin, this is a good question for you because I know you're in this quite a bit. How would we describe the difference between how it's done today and how AI really will make things different, how it does post-close QC and how it changes and transforms that entire process?
Yeah, and so Stephen, I did have an opportunity to read that question. So, and I agree with the question about the definition there. I think we're focusing on the wrong thing there, though, meaning, is AI probabilistic? Yes, it is. But AI is deterministic in the way we use it. So, for instance, and this is where I started, we manufacture automation quality data. Now, what do you do with that data? Stephen alluded to it earlier. Kevin talked about RPA. Currently, what does RPA allow us to do with our current state of data? It allows us to make bad decisions faster, right? What we want to do is make really good decisions based on highly accurate data that's validated across sources. Sourced from the borrower, sourced from a document, sourced from direct source data, and ensure that we trust the authoritative source, correct the others, and then make decisions based on that. And that's how we'll use it in post-close QC at first, right? To be able to trust it, to ensure that we're classifying the documents correctly, we're stripping the data out properly, we're finding all of the discrepancies and the inaccuracies within the document set and within the loan file. That's what's going to be different. So it doesn't really matter the definition of AI. It matters that we can be deterministic about the quality of the data.
That makes perfect sense. Thanks, Devin. Anyone else in the panel have any comments around that?
Yeah.
No. All right. Well, this has been a great discussion. I'd like to thank all you guys. I've been jotting down some key takeaways here. I know we covered a lot in a very short period of time, but I think there really are some very important key takeaways. When we all think about AI, I'll simplify what I think I heard, and that is don't boil the ocean. Don't try and take AI and say I'm going to change my entire process and apply it to everything I do and have this amazing ROI and sell it to your key stakeholders because there's just too much there. Find a place in your process that you know well and that you can really understand the difference between what's happening today and what can happen tomorrow as you apply AI. Measure that. The ROI may not be gigantic, but if it's measurable and well understood, it provides you kind of a springboard, a way to go across your entire set of processes. But at least you're starting somewhere that is very contained and very understood, and you're not boiling the ocean, which could be fraught with a tremendous amount of risk. So that's one key takeaway. Another key takeaway that I heard, which I think is brilliant, and I don't think I hear it enough, and that is AI is only part of the solution, right? So look at people, processes, look at how AI is changing these processes, look at how people are embracing these processes and maybe sometimes rejecting them. but look at this very holistically. Look at your entire organization, people, process, and technology, and that's where you'll get the greatest uplift. And then I think at the end, the losers and the winners, I mean, it's clear across any industry, not only just ours, and that is the ones that ignore technology innovation are the ones that eventually will fail. It may take quite a while, but the ones who embrace it, but embrace it in a real prescriptive way, I think the way we've been describing it, will be the winners. And finding ways to apply this level of intelligence and automation across the entire lending process, ultimately, I think will transform lending business models. Are there any other key takeaways, gentlemen, that you think I missed that you'd like to bring up?
The only thing I'd say, Stephen, is different than the technology. The technology can enable other business lines. You know, we talked about the leverage of data, and I think lenders of the future are going to be the ones that, you know, look at their process and say, what's required? Homeowners is required. Is there an opportunity for me to monetize homeowners? At the end of the process, borrowers often think about acquiring debt and protecting that debt. How can I leverage the data to better predict those folks who are going to engage in purchasing homeowners for me or purchasing some form of debt protection at the end of the process? And that's going to increase profitability significantly.
Yeah, I think the one other piece too is always have an eye on what makes the process work better for the consumer. Our process right now in the mortgage industry, and we use the term manufacturing a few times today, is really a process designed to manufacture an asset for an investor. And we sometimes, and frankly, the salespeople partially are paid a lot because they are smoothing over this pretty rough process and keeping the consumer engaged as they go through it. So to the extent we can improve a process for the improvement at the consumer level, that will be another winner. And I'll give you one stat because I said this recently and someone went, whoa. We survey about 1 million consumers about their mortgage experience over the last few years. We do this on behalf of lenders. 28% of consumers say they were asked for the same information more than once. Their NPS score drops 50 points. So, I mean, that's just dumb. Now, It's probably the trust thing in there. You know, so I asked it and asked it again, and you didn't give me the 7th page, back to where I started. But, you know, at some point, you need to measure that level of detail around your impact on your consumer, because it will show up in high customer satisfaction scores if you can bring out some of those impacts in the process.
That's great, Garth. That's awesome. Well, thank you, everyone. I just want
to throw in one last comment, too. On
go, Kevin.
Galucci. Tom, you got anything you want to say?
No, go for it, Kevin.
Yeah, I just could say, as you know, if we have some groups on here that are lenders, I know that like last July was tough and everyone was going through their vendor contracts and looking at their spend and trying to cut costs. But you just can't stop R&D. You can't stop disrupting. I mean, you know, our top competitors in this business never stop. You imagine if Samsung was like, yeah, the economy's kind of slow and I'm just going to chill for a year and we'll just stop spending. Oh, next iPhone comes out, you know, they're not stopping, and it's going to be awesome. So, you know, our business is getting a little bit like that, and so you have to keep trying to be better and invest in this kind of stuff. So we're all about it over here. So anyway, that's all I got. Thanks for having a great conversation.
Yeah, no, that's great. Thank you, Kevin. Well, thank you everyone for attending today's discussion. We really appreciate your attendance and all these great questions, and the panelists, all the great dialogue. If anyone on this call wants to learn more about AI and learn more about True, please visit our website at true.ai or send us an email at info@true.ai. I think it was Tom and Garth who mentioned a few times the white paper that we produced recently. If you're interested in a copy of the white paper, you can download this directly off the true.ai website. Also, at the end of the webinar, you'll see a quick pop-up, and there'll be an ability for you to download the paper directly off the back of the webinar. And with that said, gentlemen, again, I appreciate your time. Fantastic dialogue, and I look forward to the next webinar. Thank you all.
Okay.
Thank you.
Thank you as well.